Good morning, everyone. Welcome to this TradeStation Masterclass, everyone. Today is February 18th, and it is a Tuesday. So thank you for taking time out of your schedules and being here to talk a little bit about TradeStation in this particular masterclass, which is focused on technical analysis. There are three studies that we're going to take a look at: stochastics, RSI, and percent R. They have their similarities and they have their differences, and we're going to talk about those in just a moment. My name is Jesus Nava, for those that don't know me, and I'm the Director of Client Training and Education for TradeStation Securities. For me, it's always a pleasure to be here, so thank you for taking the time and joining me. Let's go through some disclosures before we jump over to today's topic. Every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation. Also, active trading is not suitable for everyone, and past historical performance is no guarantee of future results. Even though this is a technical analysis class, I am going to share a strategy with you guys that I put together this morning. I'll talk about it when we get a chance and we go over to the TradeStation platform. But if we do look at a performance report, just be aware that whatever the strategy does in history does not mean that it's going to do the same thing going forward. If anybody needs additional information on these disclosures, go to www.tradestation.com/important-information, and you'll find all the risks disclosures there as well. If you haven't looked at the chat window, that's where the two links are. I am sharing with you the PowerPoint that I'm going to display on screen at the moment. And I'm also sharing with you some custom easy language code, which we're going to get through at the very end of this class. If you don't see anything in the chat, let me go ahead and paste everything here one more time so that you have both the PDF and also the easy language document, okay? If you have any difficulties downloading any of the links that I'm providing you, please send an email to education@tradestation.com. Let's go through these three studies: stochastic, RSI, and percent R, and the reasons why we put them together in a presentation. The reason why they're all together is because they are very similar in what they do. So let's go ahead and talk through them and talk a little bit about overbought and oversold oscillators. By the way, this PowerPoint is just a few notes that I've taken in my studying of these indicators, and hopefully it also provides you some useful information on these studies. The nature of overbought and oversold oscillators is that they're going to compare the closing price, whatever the closing price of the security is, to a channel. And that channel, of course, is established a higher high and a lower low in a look back period. Most of the time, these indicators will use a period of 14 bars. And it's interesting that we say the word bars because these are not 14 days, as a lot of users may be accustomed to. In TradeStation, our indicators and studies and strategies are all based on the number of bars that are loaded onto the chart. So when I say that these studies are using 14 bars, think of the type of chart that you're looking at. If you're looking at a daily chart, of course, they're going to represent 14 days. But if you're looking at a 5-minute bar chart, then it'll be 14 of those 5-minute bars. So the calculations, of course, are going to change. But all these three indicators are going to look back 14 trading days and establish a high to low channel, and then determine where the closing price is in relationship to that. They all do this in slightly different ways, but very similar. When oversold markets have fallen sharply and are expected to bounce higher, so that's one of the first concepts. The market has reached an extreme, fallen sharply, and they are what's called an oversold state, and they're expected to bounce and go higher. The other side is when the market has reached an extreme on the higher side, has broken the channel, has penetrated that band, and eventually is expected to come back down and decline. That's pretty much in a basic explanation what an overbought and oversold oscillator does. It may indicate the end of a trend or a short-term pullback. A lot of times, when markets are overbought or oversold, they tend to maintain that oversold and overbought status because there's a lot of momentum, there's a lot of strength when a market is overbought and oversold. But eventually, the steam will be depleted and the market will go in the opposite direction, whether it is for a short-term pullback or for a continuation of the trend. So those two things may happen. The effectiveness of the trading signal varies. So confirmation from other studies is suggested. And this is something that I also say in all my technical analysis classes. We need to confirm the technical idea with other indicators to make sure that we have consistent signals across different studies. Let's talk a little bit about these studies in more detail. By the way, that last bullet point that showed up at the bottom, generally shorter duration trades than trend following trades, that is the nature of an oscillating study or strategy. When the markets are oscillating between a channel, that's when the strategy shines. If the strategy or the security is trending up or trending down, these type of indicators don't do that well. Ideally, if you are designing a strategy, you would want a strategy that adapts to market conditions so that when the prices are trending, then you're using a trending signal. But when the prices are oscillating between a channel, you want to use an oscillating strategy. So I haven't done a lot of work on combining these two concepts into strategy, but it would be interesting to create a strategy that does that switches, from a trend following strategy to an oscillating strategy like these three studies that we're going to talk about today, starting with stochastic fast and stochastic slow. Stochastic fast and stochastic slow, by the way, these are two studies that appear on the TradeStation list of studies. And a lot of times you're going to be asking yourself, what is the difference between a stochastic fast and a stochastic slow? If you check the list of strategies, you're going to find that there is a stochastic slow strategy. There's not a stochastic fast. The reason for that is because stochastic slow is usually the more common study, the more common concept, and the one that's traded the most. Although, in order for you to reach the stochastic slow, you have to calculate stochastic fast. So yes, it's one step. There's one step in the calculation that's different, and it separates these two studies. But let's go ahead and talk through them. The stochastic oscillator was developed by George Lane in the 1950s, compares the close relative to a 14-bar high-low range, exactly what we talked about. The 14-bar high-low channel and where the closing price is in relationship to that channel. This is a specific formula that's plugged into the chart. It takes, the close minus the lowest low. It gets the highest high minus the lowest low to know the difference between that channel. What is the spread of that channel? And then it divides the distance, of the close to that lowest low into the whole channel. And that gives you a number. It's multiplied by 100, and this is called percent K. Remember what percent K is, because percent K is one of those pieces that gets calculated inside stochastic. Stochastic fast uses percent K as it is, and it's more sensitive to price changes, resulting in more trading signals. Now, stochastic slow, notice what it does. It just takes percent K and applies a 3-period moving average, which reduces the number of signals. It's going to reduce the number of signals because it's an average. And an average, of course, is going to make the indicator a little bit more lagging than its original calculation. Percent K, it's a straight out result of the formula that we pointed out. And then percent stochastic low takes that percent K and applies a 3-period moving average, making it a little bit slower, reduces the signals, but a lot of times, the signals are a little bit more consistent. You don't get a lot of that back and forth and the flipping back and forth between that line. So the signal line, percent D, is a 3-period moving average of percent K. Those are the two lines that make up the stochastics indicator, percent K and percent D. And the signal is the relationship between those two. So let's go ahead and take a look. Let's take a look at a little bit more about the stochastic. Values are going to oscillate between 0 and 100. This is the same for all three indicators, stochastics, RSI, and percent R. A value 80 or greater is being overbought, and a value of 20 or less is being oversold. In this PowerPoint, you're going to find a lot of the information is repetitive because of the similarity between these two studies. or 3 studies. We're going to just make it quick. These are notes based on these indicators, and you're welcome to download that PDF from the chat window if you want to keep it. A value of 80 is interpreted to mean that the price closed above 80% of all prior closing prices that have occurred over the past 14 days, which is pretty interesting the way that is presented here, because a lot of times, you know, we hear about overbought and oversold. We know that the levels are 80 and 20, but a lot of times we don't realize that if the value is above 80 is because, you know, the price has closed above 80% of all prior closing prices over the past 14 days. It's an interesting way of looking at this oscillator. So you can adjust the 14-day period. That's something that is, you know, available on these studies for you to modify. And of course, the more time, you know, the more or the less sensitive it becomes to recent data. That's because it's dragging all that historical data. If you increase that number, if you keep the number short, of course, the historical data will drop off faster, and it'll make the indicator a little bit more sensitive to what's happening right now. Of course, it also depends on the time frame you're using. If you apply this on a weekly chart, you're talking about 14 weeks of historical data. If you apply it on a daily chart, you're talking about 14 days. If you apply it on a 1-minute chart, you're talking about 14 minutes. So yes, it is going to be sensitive to the time activity based on the time frame that you have on the chart. But think about the ability for you to change the length or the period in order to change the sensitivity of these indicators. Strong trends can maintain overbought and oversold conditions for an extended period of time. So you're going to notice that whenever these studies reach these extremes, that's not where the signal is generated. Because a lot of times, you know, yes, the security can reach an overbought or an oversold level, but that may just be the beginning of a trend. And it may maintain that strength throughout a period of time and maintain its overbought status, because of the same thing happens if it's trending down. And if the markets are oversold, that is not the signal. The signal is not the first time that the security becomes oversold, you know, because it may continue to be oversold for a prolonged period of time. It is when it returns from those extremes that we have to watch. And that's some of the things that we're going to talk about today. So the signals on the stochastics, and you're going to notice that the signals are very similar across all these 3 studies: stochastic, RSI, and %R. I keep on saying the same, you know, the 3 names over and over so that we understand that they are very similar to. Okay, so the bullish signal, %K and %D. We talked about these 2 lines. We looked at the formula. And what we're looking for is a crossover of these 2 lines in an oversold market. Now, that's the keyword right there. So we're looking for the 2 lines to cross at the very bottom of the chart. Let me go ahead and over here to a TradeStation chart and take a look at, because I want you guys to get a visual of what the indicator looks like and what type of crossover is it that we're looking for to establish this bullish signal. So I'm going to start off here with a chart analysis window. Doesn't really matter what symbol pulls up. I can use whatever it is. This is, okay, this is Tesla. Let me go ahead and resize this. And for this example, let's make the time frame a daily chart. I am going to remove account orders and positions. So that's my trading activity. I'm going to go to studies, add studies. And in the list of studies, I'm going to click inside the box, press my S key on my keyboard. That'll make the list sort to where the S's are, and I find stochastic right there. Notice that you have a stochastic fast and a stochastic slow. I'm going to choose the stochastic slow because it's the basis of the strategy, but you can choose the fast and take a look at which one would provide you better results. I'm going to choose the stochastic slow. I'm not going to change any settings. It's going to be exactly the way that it comes out of the factory. Let's put it that way. So what we're looking for, this is a bullish signal. In fact, I see a bullish signal here happening on this chart. We do have crossovers between %K and %D. By the way, %K and %D are the 2 lines that you see here, the cyan and the red one. When in doubt, just click on the background of the indicator and you can see the 2 colors right in there. If you look at the tooltips right there on this information box, you'll find slow K and slow D in there. And you can notice that slow K is the cyan color and slow D is the red color. We know that the slow is just a 3-day moving average of the fast, or what we call slow K. So we know that those two lines cross over multiple times, in their indicator. But what we're looking for is the crossover happening when the security is oversold. So right here, this would be a bullish signal because the crossover is happening when it's oversold. The same right here. Notice that we recently had a signal. Let me see on what date. This was February 12th. We had a bullish signal on the stochastic on this bar. Now, this would have been an interesting trade because the market did follow through, and we have 3 bars that are kind of giving us an uptrending kind of movement. But the signal is, again, the crossover of these two lines while it's in a oversold level. The bearish signal is the opposite. We are going to see the K cross under D in an oversold level. So we're talking about the opposite scenario. So let's go back here to the chart. We're looking for the blue to go under the red, like right here. That would be a bearish signal, considering that it's happening when it's overbought. Of course, a lot of times, that trade is not going to stay consistent and it's not going to provide profitable results all the time. This is a bearish signal that happened on December 9th, but instead of the prices dropping, it actually was the beginning of a big trend. And you can see how the market sustained that overbought characteristic for a few, I would say 1 week more after that bearish signal. It wasn't until right here at the very top of this movement that we get another bearish signal, and that's the one that followed through, and we had a drop in prices. So not every signal is going to be reliable, and that's why it is recommended that you look at other technical indicators to make sure that what your interpretation is what really happens in the market. And there's going to be, of course, a lot more studying to do. So we have the two signals, bullish and bearish. What other type of signals can we gather or can we take out of stochastic? We have a bullish divergence. That's whenever the price records a lower low, but stochastic forms a higher low. So you have like contradicting, the prices are going down, but the stochastic is kind of leaning towards the top side. And a lot of traders trade that as a bullish divergence. We have a bearish divergence, which is the opposite. The prices are kind of heading upward, but then the stochastic is showing you that it's going down. Now, of course, we can sit here and go through the chart and find different scenarios. For example, the one we just pointed out, we saw how the stochastic were pointing down, the price activity was actually pointing up. And it's a clear, divergence. Now, is it a bullish or bearish divergence? That's something that you have to determine based on where the prices are headed. So let's go over here to my PowerPoint. Divergences may be confirmed by a cross on 50, which is the center line of the stochastic. So that's the stochastic. Percent R is going to be very similar because it's going to look at a high-low channel and see where the closing price is in that channel. This was created by Larry Williams. You find it in most trading platforms, and you find it in TradeStation as well. If you go to the percent or the special characters, which are usually towards the top, and you find it there. Again, this plots between 0 and 100. Values over 80 are going to be overbought. Values under 20 are going to be oversold. Sound familiar? Yes, because it's exactly the same as the stochastic. It's a channel between 0 and 100 and where the value of that percent R is. Here's the exact formula, and you can see that the difference between this formula and the one for the stochastic is that the percent R uses highest high in its calculation, whereas stochastic uses lowest low. But again, it's just the relationship between that closing price and the channel. One is going to tell you the proximity to the upper band, and the other the proximity to the lower band. Again, this percent R uses 14 days to establish the higher high and lower low channel. And of course, here it tells you the difference between percent R and stochastic is that it compares the closing price to the highest high, and stochastic uses the lowest. But you can see the similarity. I mean, they're exactly the same. It's just the formula is different. When it comes to how it looks on TradeStation, Let me go here to my TradeStation and go to add study. All right, let's do shift 5, sorts to percent. Here's percent R. I'm not going to change its default settings, but you can see that the concept is very similar. The two indicators look very similar to each other, where you see these horizontal green lines that identify those overbought and oversold levels. And then you have the oscillating line between, those overbought and oversold levels. For the most part, you're going to see that when stochastic is overbought, the percent R tends to be overbought as well. And you can see how some crossovers happen exactly at the same moment. That's because the formulas are very similar. One uses the highs, the other one uses the lows. But again, this is just how the closing prices are in relationship to this high-low channel, 14 trading bars. Very similar. If you go back here to the PowerPoint, we have some of the signals. Overbought and oversold readings don't mean a reversal. We talked about that because once a security becomes overbought or oversold, it could maintain its overbought and oversold status for a prolonged period of time. So what they do is they're just sometimes confirming the trend. Yes, it's overbought, but it's because it's going up. It's just going to continue to go up, right? And sometimes it'll just be overbought for a period of time. The bearish signal, a move below 50 after an overbought reading. So what we're looking for is once you're overbought, meaning that you are on the blue side, overbought is here at the bottom, you're overbought, the reading above 50 is what is a confirmation that something is happening to the trend. Of course, there's no line here at 50, but we can create it if you want. I'm not sure if you guys know how to create lines into indicators, but it's something that you can do. If I wanted to have a line here at 50, considering that I want to track it, let me show you how you can quickly add that. I'm going to right click here on this study, and I'm going to go to edit easy language, because one of the things you need to learn is that for you to make modifications to any studies in easy language, you have to know a little bit about easy language. And it's not difficult. And that's the reason why we call it easy language, is because it's not difficult to learn. Yes, there is a lot to learn, but to make small modifications, rather simple. I want to go to edit the easy language for %R. And inside the code, it may feel a little bit overwhelming when you're first looking at it, because this is easy language code right here. But you're going to notice that I have plot statements. Plot statements are what draws the lines of the %R. I know that I have my overbought and my oversold. What I need to do is I need to add another plot. I'm just going to hit an enter key here, and I can do that on the original, or I can create a new one. A lot of times, if it's just a line, I may just add it for, and I don't really need all these other words that you see here in plot 1, plot 2, and plot 3. All I need here is the number 50. And then you put the 50 inside parentheses, then you put a semicolon, and that's it. Anytime that you need a horizontal line at a particular value, just go into the indicator, create an additional plot, just find what the last plot number is and pick the next one. This is plot 4, 50 in parentheses, and it's going to draw a line at 50. Let me verify this, and that should add the line automatically to my study. Let me go back here to my TradeStation, and you can see the line. It may not be the right color or the right thickness, but it's fine. I can then come down here, double click on that line. Let me go here to style. I may want to make that line a dotted line, and the color, I may want to do it, the same. I'm going to make it the default and say yes. So every time that I add it again, it'll have the same color. So let me click OK. And now you can see that I have a 50, the dotted line. I'm not sure how clear that dotted line is on my projection, but that's a dotted line letting me know where 50 is. Because if we go back to our PowerPoint, the signal, the bearish signal, says a move below 50 after an overbought reading. Overbought. So overbought would be up here. I don't know why when I read it the first time, I said I was looking at the blue ones here, but overbought is up here. And what we're looking for is for a crossover 50. Now you can see that on the %R, the activity almost reached my 50, but here it kind of, the value that %R reached can be seen in the box. You can see %R, it was 51.92. So we're still a little bit above 50. It didn't cross it. In fact, notice what happened to the %R. It kind of bounced off that 50 bar and it went up to the overbought level again. Finally crossed that 50 and went to the other side, or the oversold. Interesting behavior. So these are ways in which you can interpret the signals, not only of stochastic, but also percent R. Of course, if we have a bearish signal, we have a bullish signal, which is the opposite, a move above 50 in an oversold reading. We are at the bottom, we're oversold, and we're looking for that percent R to go up and cross over 50. Momentum failure, failure to move back into overbought or oversold territory after being there consistently is a signal that momentum is changing and price may move significantly. Move through 50 may be used as confirmation. Now, it's a failure to move back into overbought or oversold territory after being there consistently. Now, that happened clearly here. See what happens? It was consistently overbought for several days, even a couple weeks. It went down. This is a failed confirmation right here, what the PowerPoint calls a momentum failure, because it seemed like it was going to go up again, but no, it actually went down, crossed below 50, and that's when it said, well, momentum is gone. It depleted, its strength, and now it's going in the opposite direction. All right, let's go to the RSI, because the RSI, again, very similar study. It's 80 and actually it's not 80 and 20. RSI by default uses 30 and 70. So the overbought and the oversold levels for the RSI are slightly different than the stochastics and the percent R. The reason why, I'm not really sure, but it was developed by a gentleman by the name of Wells Wilder in 1978, and it measures the magnitude of price changes to identify overbought and oversold condition. The way that it does that, and this is just a little bit about the math, if you're interested in the specifics on the formula, I also recommend that you open up the easy language code, because that's where you're going to find the details on how these indicators are calculated. But just to let you know a little bit about how it's calculated, this calculates the net exchange average, how much the price changes up or down, and then it creates an average. Did it change 1 point or 2 points? And those changes are what's being averaged, not necessarily the value of the security, is the change. And that's an average that's created. And then it creates an absolute total price change average for you to plug that into a formula. Divides the net by the total to return a ratio. Let me show you where you can find those details if you're interested in math. I'm the type of analyst that when I look at an indicator, I like to know where the values come from. And here, if I go to studies and add my RSI, this is what it looks like. But I right click on the study and I go to edit easy language for RSI. Remember, that's the way that you go to the insides of the RSI. Then this is percent R. Let me go here to the RSI tab. But if I scroll down, this is calculating RSI. Notice that it's a function. Anytime you see a word in purple, that is a function that allows you to jump to a different code. I'm going to right click on this RSI and say, open the function RSI. And if you notice, this is two things. This is calculating the net change average. This is the formula that we talked about, which is the price minus the price 1 bar ago. So you're talking about what is the change in price divided by the length. And then it has the total change average, which is calculated over here. And then it's just one divided by the other to create a ratio. And that is what builds the RSI. But again, if you're interested in the actual mathematical formula that is used to come up with these numbers, you can open up everything inside of TradeStation and see the details. A lot of platforms, they are pretty much hard-coded into the platform and you don't get to see the insides. But if you do like math, I like math myself. I don't consider myself to good at math, but I do like to figure out where numbers come from and where indicators come from. And that way you have a better understanding of how the indicator is behaving. Let's go back here to my PowerPoint. That's details on the formula, but it returns the RSI number. The signals, again, they're going to be very similar to what we saw in the stochastics and the percent R. We're looking for something that's overbought or oversold. Remember that it may continue to read overbought and oversold, but we're looking for, for those extremes to go in the opposite direction. because eventually securities will move in the opposite direction. And that's what these oscillators are trying to take advantage of. You know, you're overbought and then you drop and then you take advantage of that bearish signal. If you're overbought, I'm sorry, at the bottom, you're oversold, then you're going to cross over, you know, that 30 or 20 threshold, and that's going to be your bullish signal. So take a look at all the signals that are in here, because they're going to provide you different ways in which the RSI can be interpreted. I have the bullish and bearish divergence, which we talked about when we were reading about stochastic. Divergences are misleading in strong trends. And then you have these other ones that are bullish failure swing. RSI moves below 30, bounces above 30, pulls back and holds above 30, and then breaks its prior high. Yeah, this is a bullish failure swing, and that's something that you can read on any search engine. If you go to Google and you look for bullish failure swing, you'll find documentation that explains the signal and what it does, and you'll find different scenarios in which this happens. Let me go back here to my TradeStation. Sometimes it is difficult to find, you know, those scenarios, but what it does is, for example, right here where my cursor is, you know, in this particular case, it was overbought, then it crossed below that overbought level. Notice how it tested the overbought line, but it didn't quite cross it again. So it's meant to be a failure, and then it just goes a little bit lower on that side. Okay. Now that you mentioned that, John, the reliability of the three studies, because we talked about the similarities and how these are all built and the formula, they're very similar to each other. Now we look at them on the chart, and they are somewhat very aligned in identifying overbought and oversold levels. I would say that percent R, it's a little bit more sensitive. If you compare the three, you can see that it may, for example, right here, we have an overbought level that is not identified by stochastic and is not identified by the RSI. It's probably because maybe smoothing factors or the differences in the formula, but you can see how the percent R identifies a little bit more overbought and oversold levels than its counterparts, the stochastics and the RSI. So a lot of times you may be, you know, wondering which one's better, you know, which one would provide you better results. For that reason, I created a strategy for you to test. You know, I grabbed the strategies that are built into TradeStation, one that is based on stochastic, another one that is based on percent R, and another one that is based on RSI. You find those here, studies and add strategy. If I go to S, you find the stochastic slow LE and SE. This is a long entry and a short entry based on the stochastic slow. Then if I go to the R's, you find the RSI, LE, and SE. So long entry and short entry based on the RSI. And if I go to the P's, I find percent R for long entry and short entry. I did have to modify that percent R, and because the percent R signal of the strategy, it's a little different than the signal of the percent R indicator. We can go into the details. But in fact, let's go into the details so you can see exactly what I mean by that. I'm going to put these two strategies in here. All right. And the strategy, you know, works right here on Tesla. Let me go ahead and load more history. I'm going to load 10 years of data. Okay, there we go. So we have more history. Percent R, let me remove stochastics low for a moment, and I'm going to remove RSI. So you see the percent R calculated right here at the bottom. You can see how the strategy does not really react to all the overbought and oversold levels right here of the percent R indicator. That may be the reason why in TradeStation, percent R indicator starts with a percentage sign, like a special character, and percent R strategy, you know, starts with a P, PCT R SE, because it's different. It's based on percent R, but the signal changes. Let me show you the differences. Let me right click on the indicator first to show you what the difference is. I'm going to go to the easy language for the percent R, and let's take a look at the alert. So whenever the percent R gives you a bearish or a bullish signal, is looking at percent R crossing over oversold, or the percent R crossing under overbought. So we look at the chart. All right, so let me open this up. So we're looking at overbought here, The signal or the alert is generated when that red line crosses the overbought line. So it goes inside the channel. On the other side, yeah, it may be oversold, but the signal is only generated when it returns inside the channel. So it stops being oversold. That's where the signal is, because that's where the indicator kind of wants to tell you that the trend may be changing. Now on the strategy, it's a little different. Let me right click here on the strategy. Let me look at the long entry right here, the long entry. And I'm going to go to edit easy language for the LE. Now, if you take a look at where the buy order is, first of all, we need a setup. The setup is right up here. Percent R is less than oversold. So first of all, it needs to be oversold. This is the bullish signal. This is the long entry. So we need to be at the bottom, right? That's the setup. But then it's looking for the average to be greater than the average 1 bar ago. And this is a simple average, just a simple moving average. And it's just looking for the average to be greater than the average 1 bar ago. And then the percent R crosses over the trigger. And the trigger, if you look up here, it's not the 20. It's not the 20 over the oversold. It's actually a 62. So the conditions are a little bit different and more, I would say, a little bit more restrictive, because not only do you have to be oversold, but it's also looking for an average to be going up, and then it has to cross over the 62 in order to generate that buy order. So you're going to see that when you look at the strategy on the chart, that the strategy signals don't align with all these crossing over and crossing over. So that's the reason why I did not use the default conditions here, because I wanted my strategy to kind of simulate whatever it's happening here on the percent R. Let me remove this for a moment. By the way, I didn't create a percent R strategy separately. I should have, so that I can show it to you here and see how it aligns with all the buys and sells. But we're going to take a look at it. Let me go here. By the way, that's part of the easy language code that I'm sharing with everyone here. So if you download the ELD, let me copy it and paste it here for everyone. The code that I'm sharing is for you to test those 3 indicator strategies, or the 3 strategies that are based on those 3 indicators, to see which one provides you better results. And let me show you how I wrote the strategy so that you can see. Let me go here to my development environment, and I'm going to go here to, I don't have it open, but I'll open it in just a moment. The name of the strategy, it's going to start with @MC. All the masterclass strategies, I named them @MC, so they're grouped together. So let me go here to my strategies list. This is called @MC. Here, it's called @MC stochastic -RSI -percent R question mark. Which one provides better results? Let me go ahead and open that up. And the way that I wrote this is there is an input that controls which strategy is being used. For stochastic, it's going to use number 1, RSI number 2, and percent R number 3. And it's defaulted to 1. So if you put the strategy on a chart, it's going to start with stochastic. And right here, it tells there's sections here on the strategy. If the input is set to 1, then it's going to do stochastic. If the input is set to 2, then it's going to do RSI. And if the input is set to 3, then it's going to do percent R. Here's where I simplify the percent R strategy. I'm not using, the confirmation on the averages. I'm not using the 62 threshold. I'm just using a simple, percent R crosses over oversold. Similar to the other 2, like the stochastic and the RSI, they both generate entries whenever it returns inside the channel. So I wanted the percent R to also be very similar in that way. So let's go ahead and put that strategy on my chart. Studies, add strategy. By the way, if you're not familiar with easy language and you want to use the strategy, you have to download the file. Well, if you click on the file, on the link that I provided, the file is going to be automatically downloaded, and it'll go to your downloads folder. And all you need to do is double click on that file, and that'll import the strategy into your TradeStation so you can use it. Once you go through the importing process, all you need to do is go to Studies, Add Strategy, and I'm going to scroll up because it's MC. That's the prefix of all these strategies. And here's the strategy: stochastic, RSI, percent R, question mark. I'm going to click OK. And as we said earlier, this is a strategy that will default to stochastic. But if I want the strategy to be based on the percent R, all I need to do is double click on the strategy signal. I go into edit strategy. I'm going to click customize here and change my input, the one that I created, to number 3, which is the percent R. That's the percent R strategy, uses the percent R condition. I'm going to click OK and click on close. Now, this strategy, you can see that it's a little bit more sensitive to what's happening here in the stochastic. Like every time that there is a return, like for example here, let's take a look at this area. We can see that the security was overbought. Very clear, right? It went into the red. Then it went down here. We had a crossover on this bar, which is this is October 29th of last year. But this is the signal. And then it generates a short entry right there when it crossed. Now, this is a terrible trade. I picked out the worst trade out of the sequence, but it's totally fine. I mean, this is just telling you that it's just doing exactly what the indicator thought would be a good trade. This is a bearish signal, but the price activity, you can see that it just skyrocketed to the top. But I wanted to show you that it didn't get out of that trade, and maybe that's a signal that tells you that this strategy needs a lot of work, because we need a way to prevent any trades to generate this type of loss. We need a stop loss, something that manages our risk. In this particular case, we don't have that. But what I wanted to show you is that the signal is generated based on the signal that is triggered. But all these other crossovers that are happening as the market is trending up are little corrections. The market's still trending up, and these are all false signals, right? And it doesn't generate more short entries because you are already short. It's not until the strategy goes on the opposite side of the oscillator, it is oversold, and then it generates a bullish signal that it's able to get, out of that trend. Not a good setup. It's doing exactly what the strategy is intended to do. All right. Now, one thing that you can do once you have the strategy in place is optimize it to see all 3, which one is the one that would provide better results on this particular security. Let me rephrase that, because this is all based on historical data. Now, we need to be aware that, whatever happens in history does not necessarily mean that it's going to happen going forward. And again, if I identify one of these signals to be better for Tesla than the others, it doesn't mean that it's going to continue to do that going forward. But it does provide me an understanding on how Tesla reacts to all these oscillators and which one favors Tesla more in history. Will it do the same thing going forward? Well, that's something that we can test by doing forward testing. In this case, I can edit the strategy, go here to customize, and I can select the field where you enter the number of the strategy that you want to pick. And instead of entering a number, I can say optimize. And I'm going to optimize 1 to 3 in increments of 1. So it's going to test 1, 2, and 3. And it's going to pick the one that has the best performance, historical performance. I'm going to click OK, and then just click on optimize. This optimizes very quickly, and it tells me that out of the 3 strategies, the one that performs the best is the RSI. You guys remember that I had other signals here that were the percent R, but RSI seems to work better for Tesla in a time span of 10 years historical data. If I pull up the strategy performance report, we can see why. We can see the total net profit, the profit factor. Let me go ahead and collapse this. Of course, take a look at the number of trades here. This is a type of strategy that I would not want to trade, or I would not trade, because of the number of trades that were generated. In a time span of 10 years, there's only 5 trades. How likely is it for those 5 trades to do exactly what it did in history? Very unlikely. And I'm looking for historical backtests that have more tests, more trades, so that I can have a better understanding, or have a little bit more confidence on how the strategy is behaving. Does that make sense? So yes, RSI in this particular case is the one that fits better on the historical movements of Tesla. If I were to change, for example, this to Microsoft, all the signals were gone. It doesn't mean that the strategy was removed. I'm going to go here to studies and edit strategies, and I'm going to customize this, and I'm going to optimize one more time, 1 to 3 increments of 1. And you can see that for Microsoft, the strategy that performed better in this 10-year period was percent R. it actually generated better results. If I go back here to the strategy performance report, it was almost a break-even strategy. You can see how the gross profit was 55K, the gross loss was 50K, giving me a profit factor of 110. And this is without, without considering costs of trading this strategy, without considering slippage. So there's other costs associated with trading strategies that are not accounted for here. So after all those costs, maybe this is just a losing strategy altogether. But this is a good way for you to test ideas. You set flags and you can optimize that flag so that it finds and cycles through all the different scenarios and finds which one is more fitting on that historical. So hopefully I've given you something to play with. Also ideas on how you can combine, different concepts and different calculations into one study. A lot of times, we know that there are studies that do similar things, but what are the differences? How can I determine which one works best on the security that I'm wanting to trade? So these are the type of things that TradeStation allows you to do easily because it's an open book. It's a very sophisticated platform, but it does allow you to do these types of combinations and testing that are probably not possible on other trading forms. Okay. I don't see any more questions here. So hopefully everyone is clear. If you do have any follow-up questions, please send me an email at education@tradestation.com. Let me go ahead and put that email address right here, just so that you have somebody to ask about our educational content. But for me, it's always a pleasure to be here. Thank you for joining me today. Have a wonderful afternoon, and please check our events calendar for upcoming sessions. Thank you for being here. Bye-bye, everyone.